Hi, my name is Mike Freitas, and I'll be presenting the American Chemical Corporation case study. So in order to assess their performance, you have to look at them relative to the rest of the industry. And from a shareholder point of view, it's done pretty well. While most of the industry is facing steady share prices, Americans over the past 5 years had more than doubled. And if you look, their PE ratio is still well below the industry average. So you figure that they haven't hit their highest possible share price. In addition, they've had steadily growing dividends. Now, while their sales might not be all that impressive, since it's stayed the same compared to 5 years prior when the rest of the industry has grown significantly, the point where they manage their costs is where it's strongest. Most of the industry has taken that double in sales, and in many cases their net profit has gone down, whereas for American theirs has actually gone up, which would seem to indicate that they're controlling their costs and putting those sales to better use. So it would seem logical to say that if they were able to expand their capacity, they could increase sales and turn a greater profit than other companies could. Now that in turn leads us to the competitive environment for both American and Collinsville. More specifically, I was focusing on the sodium chlorate market, which primarily goes to feed the paper and pulp industry. 85% of their output is going to that particular industry. And it's very heavily concentrated, both in terms of the companies involved and the locations. About 2/3 of the production takes place in the southeastern U.S., and over half is through 3 specific companies. Now, they're particularly competitive because they've managed to take an increase in demand and have an almost lack of capacity, which means not only are their sales growing, but their margins are at the same time. Now, this is looking to decrease towards the start of the 80s due to both an increase in capacity due to 2 new factories opening and a noticeable increase in power costs due to the TVA having to rely more on fossil fuels. So it would appear that margins may wind up shrinking in the immediate future. However, in the long term, it still looks to be a strong industry where companies can grow, and that in turn leads to concerns over competition and antitrust actions, which is why the lawsuit was brought up against American and triggered the potential sale of the Collinsville plant. Now, in order to find a levered beta for the Collinsville plant, we had to start by getting an industry beta that was unlevered. So to do that, I took the 2 companies that specialized in sodium chlorate, since they were the most comparable to the plant, and found their unlevered betas and used an average of those for the industry. And then from there, you take the unlevered beta of 0.94 and plug in Dixon's optimal debt ratio of 35% debt to 65 equity to get a levered beta of 1.44. Now, I could have used their actual ratio after the acquisition. However, I assumed that Dixon would move more towards their optimal ratio, and that while it might work better for this individual plant, they have to look at their assets as a whole, and the Collinsville plant only serves as a part of that. Now from there, it was just a matter of plugging in numbers to find the cost of debt, equity, and overall cost of capital. I again relied on the optimal capital structure for Dixon and took the relevered beta and plugged it into the CAPM model to get a cost of equity of 20.36% and the cost of the notes to acquire the property and the tax rate of 48% to get an after-tax cost of debt of 10.6%. And took those, combined them to get an overall WACC of 15.3. So again, while you could probably decrease their overall cost of capital by increasing the debt, I have to assume that there are more factors at play. They may not want to take on additional debt, and there may be shareholder interests involved that make that decrease in cost of capital less attractive. Now, with that information in hand and the pro forma financials that were generated and deciding whether or not it was worth it to purchase the plant, I looked at 2 different scenarios to determine the net present value of the property. I looked at one option where they simply held onto the plant for 5 years and then sold it, and a second one where they held onto it for the full useful life of 10 years and then junked it with no salvage cost for the tax benefit. And for the first 5 years, I was able to rely on their statements, and then I assumed that growth remained relatively constant. And it wasn't good. There were negative net present values for any option that I looked at, and it was generally looking like they were going to lose well over $1 million on this event. So just looking at the plant in and of itself left it a less than attractive asset to acquire. However, that doesn't tell the whole story. The laminate technology that Collinsville could have installed is where the plant was going to redeem its money. Essentially, it allowed them to hedge on some of the problems that they were facing, since increased power costs would make laminates more attractive, and decreased power costs would mean that they had a better profit margin. So I started with a relatively conservative estimate, took the low end for how much power it would save, took constant price growth over the following 10 years, and using the same cost of capital and everything, it more than offset the cost of the plant, leaving them with a potential net present value of in excess of $4 million. And when I looked at it, it was just better to look at the full 10 years. Because since I was assuming that prices would continue to increase at a extreme rate, it made the long-term possibilities more attractive, because that power cost kept compounding and it made the laminate save that much more money. Now, from an economic point of view, there were two clear options. If the company were to go after the plant and not the laminate technology, it wasn't worth it. While if they installed the laminate, it was well worth the price paid. So with that in mind, I would support the purchase of the plant. However, it's not without its risks. The models that they prepared in determining the value would have to be right and optimistic on the growth of prices and the possibility that there wouldn't be an even greater increase in capacity, which would further drive down margins and force them to reduce costs. Furthermore, if they added more capacity, that would mean an even greater draw on the power system, which would further drive up power prices, worsening their situation to an even greater degree. Now, from a strategic point of view, Collinsville is pretty attractive. It's located where they're already operating. They have connections with the customers that are already there, and there are products that are similar to what they're already selling. So it allows them to expand their current sales, possibly move into new markets, without significantly expanding their overhead costs. Now, with that in mind, there are some pitfalls in that they're going to have to be reliant on American in order to upkeep the plant and install this new technology. And if Dixon winds up being too great a competitor, that could work against them. However, with that in mind, if properly managed, the Collinsville plant is an attractive acquisition. So with all that in mind, I would recommend that management go through and acquire the Collinsville plant, plan on installing the laminate technology, and just to be sure, perform thorough due diligence towards the American Chemical Corporation to make sure that this technology is all it's cracked up to be, because if it falls through, then that would cause the entire deal to backfire for Dixon. Now finally, all this means nothing if Dixon can't pay the bills to go through with it. And considering their strong financial position to begin with, they'll be able to afford a rocky year immediately after acquiring the plant in exchange for long-term success. That first year, they're going to be looking at approximately $2 million in loan payments, in addition to another 2.2 to install the laminate. Now, the plant could make up about a quarter of that, but the rest would have to come from Dixon, and that'll look bad for them in the first year in terms of cash flows. But after that, once the plant is up and running on its own, they'll be reaping the benefits over the next decade, which is exactly what they're hoping to get out of this.